Welcome to Institutional Weekly by Finery Markets, your front row seat to the most significant moves in digital assets. This week, Bitcoin shattered expectations by reaching a new all-time high of $111,970. Though on-chain metrics suggest the market remains surprisingly balanced rather than overheated. Meanwhile, regulatory momentum is building as the U.S. Senate advances the Genius Act to establish clearer stablecoin frameworks, while major American banks are reportedly exploring a collaborative stablecoin initiative. Institutions are making bold moves. Let's dive into this week's key developments. Bitcoin has shattered records by reaching a new all-time high of $111,970, though market indicators suggest this isn't a typical overheated rally. The surge, which occurred on May 22nd, eventually settled around $108,000. What's particularly interesting about this rally is that traditional warning signs of market excess are notably absent, with funding rates showing only moderate elevation and short-term holders demonstrating restraint in profit-taking despite significant gains. Looking at key metrics, the spent output profit ratio, SOPR, for short-term holders sits at just 1.02, indicating that while recent investors are profitable, they're not rushing to cash out. The Bitcoin MVRVZ score, a crucial long-term valuation indicator, stands at 2.8, significantly below levels typically associated with market peaks. On-chain analysis reveals a strong support level has formed between $93,000 and $95,000, thanks to substantial Bitcoin accumulation in that range. This could provide important price stability during any potential pullbacks, as demonstrated by recent Glassnode data showing significant buying activity in this zone. In a landmark development for crypto regulation, the U.S. Senate has advanced the Genius Act with a decisive 66-32 vote. This bipartisan legislation would require stablecoins to maintain full backing in U.S. dollars or high-quality liquid assets, with large issuers subject to annual audits. Senator Bill Hagerty, the bill's co-author, emphasized its potential to reinforce U.S. dollar dominance in digital payments. The legislation aims to capture a significant portion of the $160 billion global stablecoin market, directing that demand toward U.S. treasuries and domestic financial infrastructure. The institutional landscape for cryptocurrencies continues to evolve rapidly. Major U.S. banks, including J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, are reportedly exploring a collaborative stablecoin venture. This initiative would leverage existing financial infrastructure through the clearinghouse and early warning services, though its progression depends largely on regulatory developments like the Genius Act. The joint venture represents a significant shift in traditional finance's approach to digital assets, potentially creating a powerful alternative to existing crypto-native stablecoins. Finery Markets has established itself as a crucial player in institutional stablecoin trading, processing over $3 billion in transactions throughout 2025, a 157% year-over-year increase. Their platform connects 140-plus takers and 15 regulated liquidity providers across 35 countries, offering rapid pair launches and real-time settlement capabilities. The platform provides stablecoin issuers with immediate access to institutional liquidity, supporting FX settlement in 20 fiat currencies and enabling pair launches within 24 hours without capital requirements. The crypto market received another boost as Bitcoin and Ethereum ETFs recorded a remarkable $1.05 billion in combined inflows on May 22nd. Bitcoin ETFs dominated with $935 million in inflows, while Ethereum ETFs attracted $110 million. This surge in institutional interest coincided with Bitcoin's new price record and suggests growing confidence in crypto as an asset class. Analysts note that the current rally appears to be driven by genuine spot demand rather than excessive leverage, indicating a more sustainable price movement. In the security realm, Sui-based Cetus Protocol faces a significant challenge following a $223 million exploit. The protocol has offered a $6 million bounty to recover the stolen funds, which included $56 million worth of assets already converted to ETH. The incident has sparked debates about centralization in newer Layer 1 platforms, as Sui validators quickly move to freeze the attacker's remaining wallets. Working with data analytics firm Inca Digital, Cetus is seeking the return of 20,920 ETH and the frozen SWI-based funds, offering immunity from legal action in exchange. On the regulatory front, the SEC has begun reviewing Canary Capital's application for a staked Tron ETF, while simultaneously delaying decisions on several other crypto ETF proposals. This includes Bitwise's Spot, XRP ETF, and various applications from CoinShares and Fidelity. The staked Tron ETF review is particularly significant as it may establish precedents for how staking-related investment products are regulated. Bloomberg ETF analyst James Seifert notes that these delays were anticipated, with final decisions likely coming later this year. That's it for this edition of Institutional Weekly by Finery Markets. Stay ahead of the curve by subscribing to the series and following Finery Markets on LinkedIn. Get the insights that matter, delivered weekly.